Good morning. Welcome to Forex in Four. Today's Friday, October 7th, 2011. All right, this morning's we're waiting on the non-farm payrolls report, which is coming out at 8:30 a.m. Eastern Standard Time. But we just want to do a little backtrack here and show you what's happened over the course of the last 24 hours. All right, yesterday we know about the Bank of England adding quantitative easing to their monetary policy by increasing the easing by about 75 billion. And you can see here that basically took the markets down right out of the gate. And we're looking at the 30-minute chart, but we got this nice bounce here just ahead of 132. We're actually looking at euro now, but you can see, boom, it moved up higher and started moving across. We'll look at pound here real quick, show you the same things. All right, pound, boom, rebound, and not only did it come back to prior levels, all right, but it's actually exceeded them as well. Well, what's happened since? Well, we have the Eurozone, the ECB rate decision yesterday. They didn't do anything with rates, all right, but they started discussing this, the debt crisis, what they're going to do. They're talking about recapitalizing the banks. There's a lot of different things going on over there, but the overall mood is that they are now getting with the program and that they're going to go ahead and get something done here shortly. People are hoping that this happens ahead of the G20 meeting on I think it's on October 20th. That meeting is supposed to occur. All right, and then they've got another Eurozone meeting on the 13th of October, so they're hoping that something comes out of that as well. So anyway, the pound's moved higher, and this comes despite Moody's downgrading a bunch of UK banks this morning. All right, so they downgraded the banks, and boom, what happened? Pound starts going higher. So there is bank exposure to the European debt crisis, UK bank exposure to the European debt crisis. But I think yesterday's move at quantitative easing was really about saying, okay, we're going to support these banks, we're going to provide more liquidity, all right, and we're not actually concerned about potential inflation that's going on there, which, if you look at this morning's PPI numbers that came out in the UK, they did come in higher than expected, just slightly. They're expecting core 3.7, they got 3.8. These are all PPI output figures. Headline 6.3 versus 6.2. So these numbers are starting to grow a little bit. We know about the inflation over in the UK, and I think they've just sort of said, well, you know what, we're going to deal with it. If the economy slows, it'll come down, but if we can support the economy here, things seem to be doing okay. So, the UK, not in a horrible position, but it's they're really, I guess, kind of waiting out this Euro bank thing to see what happens if they need to recapitalize the banks in the UK. So we had pound moving higher, and overall, essentially what happened is that this was good for risk appetite. All right, so as I mentioned yesterday, it seemed silly that the whole market started selling off here when the UK ended up just adding more easing to try and weaken their currency, and sure enough, the market agreed, and we got the bounce higher. So that's what's happened there. Just show you dollar yen here. All right, nothing happened. We're in this tight range. You see this little bit of a move here. All right, this came out in anticipation of the Bank of Japan interest rate decision, which they didn't make any change to rate policy in Japan, and no one was expecting that to happen. They're not going to change rates, but there is a call here for a lot of business leaders and political parties and things like that in Japan to do something about the strength of the yen. I mean, the longer, we've just been sitting here right in this range, 77 to 76, and as long as yen is sitting that strong and it's near 10-year highs versus euro and pound, that eventually this is going to erode Japan's manufacturing, and it's going to be a bad thing for the Japanese economy in general. So people were kind of hoping that they'd come in and see some sort of intervention, and I think the politics of what's going on in the global economy and this whole euro debt crisis has sort of put them on edge. But it's the kind of thing where they had the rate policy meeting. A lot of people think, oh, that would be a great time for them to do it, but it's sort of anticipated. I could actually see them doing something, say, on Sunday, all right, when nobody's expecting it, when they're the only market open, so on and so forth. So if any intervention is going to happen from Japan, it's going to happen on Sunday night. I'll go out on a limb and say I'm going to call it here first, provided that today's non-farm payrolls report doesn't induce a major round of risk aversion. So we'll keep an eye on that for next week, or they may just say, you know what, we're content with it here and we're going to manage. So we'll have to see. But giving us a preview of non-farm payrolls, let's take a look at dollar versus loonie. All right, loonie is strengthening here. They had an excellent employment report this morning. What's going on with my cursor here? I apologize. They had a change in unemployment. They were expecting of adding 15,000 jobs. They actually added just under 61,000 jobs, and the unemployment rate fell to 7.1% from 7.3%. So good employment numbers in Canada, and you can see that the loonie strengthened as a result. And if we come back and we look at this here, we'll just come out a little bit on the 2-hour chart. All right, you can see that we sort of had this move higher where we had the risk aversion, and now we're sort of coming back into play. So dollar strength or dollar weakness on non-farm payrolls report? That's the question we're going to see today, and I think right now that we're expecting around 60,000 jobs to be added, of which I think 90,000 they're hoping for on the private payrolls, which means we're hoping that we get rid of some government jobs as well. All right, they're not expected to move the needle on the unemployment rate, which is still at 9.1%. Okay, and if it does, it's going to be because of lower participation rate. But I think in this instance today, there really isn't too much that's going to derail the markets from going higher and taking some risk on here, and I'll explain the reasoning in a second. But essentially what's happening is that you have two schools of thought, right? First is that we want to have better jobs numbers to show that the economy's improving, and if the economy's improving, then that means that perhaps more people that are going back to work, it's going to increase GDP, increase buying, all this economic activity, the more people that are employed, and that's a good thing for the economy and thus risk-taking. All right, the other school of thought is that if this number comes in way worse, okay, we might see an initial flight to safety and some risk aversion, but now people are going to start, and the market especially is going to pick up and say, hey, wait a second, we just had Bernanke on Tuesday saying to the Joint Economic Committee that he's prepared to go for some more quantitative easing if necessary, or whatever it is that he needs to do. So if this number comes in really bad and people think, oh, whoa, the economy's in trouble here, all right, then the expectation might be that Bernanke's going to step in and do something. So, that's really what's been happening. It seems like, the euro debt thing is sort of, I don't want to say died down, but as we've been getting economic data that's been hitting the market this week, it hasn't been horrible. It hasn't been great. It's sort of, it's like just right, and it sort of, the mood feels, pretty bad out there. But when that happens, okay, I usually think that's when you need to try and be the most optimistic as possible. So right now, I think the markets are sort of just been held back and selling, and they wanna go higher. They do, despite what's going on here in the U.S. and in the eurozone, whether it's political gridlock here in the United States with nothing getting done, or whether it's the debt crisis looming over Europe. But the markets want to go higher. That's naturally where they want to go. And I think that if we see a decent number here today, we could see an initial spike. But to be honest with you, this is probably the most important number. We're going to see increased volatility here, but don't get overly concerned about it. It is just one data point. It's not going to change what's happened the last 2 months, nor is it going to necessarily change what happens in the next 2 months, unless, of course, Bernanke decides that he needs to step up and make a move here. But it's going to come down to eurozone balancing out and figuring out what they're doing, and then hopefully allowing the economies to do their work. So that's really what we're looking at. Just be careful about that volatility. 8:30 a.m. Eastern Time, and good trading to all.